Welcome back to Morning Trade Live. It's time now for the big picture. Let's welcome in Nathan Peterson, Director of Derivatives Analysis at Schwab Center for Financial Research. Okay, so we're seeing stocks sliding for a fourth session today. It looks like AI continues to weigh on the minds of investors. We've had some cautionary headlines, you could say, from the likes of Google CEO Pichai around irrationality, JP Morgan warning of AI valuations and perhaps a correction there. We've had these downgrades for Amazon and Microsoft. What do you make of all of it?
Yeah, good morning, Sam. Certainly, just go back 2 months. Remember, we were talking about meme stocks and, the speculative excess and how, all these deals were being announced with AMD and OpenAI and everything looked great. And then, fast forward, here we are today, and that sentiment around AI certainly has shifted. A lot of that, thanks to some of the discussions around, Oracle's business model, so to speak, in terms of having heavy leverage there, Michael Burry coming out. And, a lot of the talk is about valuation. It does matter now that the stocks are not making new highs. But a lot of it has to do with over-investment and too much leverage, too much debt. I can go back to earlier this year when, Zuckerberg said that Meta would rather overspend than to miss out on this opportunity. Those kind of statements, historically, Wall Street does not like to see heavy investment. They were rewarding a lot of these companies back as early as September for these deal announcements. And now I think that kind of shifted, and we go back to Meta's quarter in late October there. They punished the stock for saying they're significantly going to increase CapEx into the new year. So here we are, and if you look at the technicals, that's what's really standing out to me. I think we could get some rotation. We've already seen that into healthcare, staples, financials over the past 2 or 3 weeks to some extent that is helping to support some of the index levels. But Sam, I think yesterday was a key technical event. So let's just talk about the S&P 500. Back on October 10th, we go down that 3% on the Trump-China tweet, and that kind of rocked markets. And we went down to the 50 SMA on the S&P 500. Then we go make a new all-time high. That's what you want to see in an uptrend. Then November 7th, we go down and we test the 50 SMA. Once again, we bounce, which is what you want to see, but we did not make a new high. And then last Friday, we go down to the 50 SMA. We bounce, but you do not want to see the frequency of these tests at a support level, a key support level like the 50-day simple moving average increase as we have. It's like knocking on the door that eventually could kind of break, or I should say the floor, not the door. And then yesterday, for the first time since April, the S&P 500 closed below its 50-day SMA. The Dow Jones did as well. The NASDAQ Composite did as well. And the Russell 2000, which has been in a downtrend for about 5 weeks now, closed below its 100-day SMA for the first time since June. So we have some technical damage here, and we may need to kind of flush out some of the excess, not so much in exposure, but in sentiment that is still working its way through this AI secular growth story. Now, we've got Nvidia tomorrow. We'll see what they have to say. But oftentimes when there's a lot of this scare that comes up, even if it's a DeepSeek type scare, we generally need to get some kind of a capitulation type flush that will help to reset kind of expectations and sentiment. And from there, perhaps we can then begin to have some repair or, get some healthy kind of technical movement to the upside.
Yeah, I suppose a lot will sort of weighs on what Nvidia has to say tomorrow, and also what the jobs report tells us as to, how the markets are thinking about that December cut or no cut. You mentioned rotation, and, it certainly hasn't been a full sell-off because we have very much seen this rotation into a sort of more value play, sort of a more defensive type trade as well. I mean, healthcare is up just fractionally today. Real estate, consumer staples are up. Materials are a little bit higher. Do you think that would continue come some of the event risks we have on the horizon this week?
It's going to continue as long as the sentiment is sour around AI. That's the belief that I have. I mean, look at Medtronic. They reported, the earnings were pretty good. Guidance, slight raise, but the stock is gapping up to a 3-year high. That just speaks to looking for relative safety or relative risk reward. When you have technicals that break down like this, we know that they fall faster than they go up. And so therefore, from a risk reward perspective, and yes, my lens is more near term in focus. I can get very nuanced. I'm not talking about 2026. I'm talking about the next couple of weeks or maybe till the end of the year. You're going to want to see some of signs of stabilization within technology, within AI, before the money begins to go look for that playbook that we've always gone to, which is growth and going back to mega cap tech, going back to where that EPS growth is, et cetera. So while we're working through some of this sludge within AI, I think, yes, that the typical playbook is when you've got a correction like we're getting within growth, the money rotates over to value. We're also looking at, the yields on the 10-year, and the Russell would be a good play if we were seeing yields fall substantially, but that hasn't been the case. So we've got that jobs data to work through. We've got some of the questions around the Fed to work through. But in the meantime, yes, start scanning, the market space is saying, give me a sub-market multiple, even if the fundamentals aren't as good as somewhere within the technology space, because at least for right now, that's where the relative safety appears to be.
Just really, really quickly, Nate, if I can pick your brains about Nvidia, I mean, what has this company got to say or do? What metrics should we look at as to what is going to be the make or break here as to whether we see some further downside or Nvidia manages to pull us out of the rut we're seeing?
Yeah, sure. So what I'm looking for tomorrow, last time Jensen Huang said, we're sold out of everything. When they were asked, had discussions about the H20 and whether that demand is waning is all because of their new product line, Blackwell, Rubin, et cetera. So number one, does his statement deviate at all or give any kind of hint that demand has come down from his last quarter statement that said, we're sold out of everything? AMD also kind of echoed those same that same kind of tone that demand is there. The other thing is with Nvidia is margins. So their margins, they've enjoyed such a moat, and they've been, they were at 76% maybe a couple years ago. I think they were around 72% last quarter. Slight degradation. That's not a big deal. That is to be expected. But if margin guidance begins to really come in lower than what the street is anticipating, then potentially that competitive threat, which we know some of the hyperscalers are building their own chips. We know that AMD is attempting to catch up to Nvidia. Those are really the two things in my mind that I have to look for. And then, of course, when we look at guidance, what is the degree of the beat? Everybody expects a beat and raise from Nvidia. To what degree is their forward guidance above what analysts are expecting?
Okay. Demand, the moat, the margins. We'll be watching. Thank you, as always, Nathan Peterson, Director of Derivatives Analysis at Schwab Center for Financial Research. Always appreciate it.